All right, let's jump into another deep dive. And today we're focusing in on the Indian stock market.
That was good.
So we're going to be looking at the weekly newsletter Volatility Coaches of India report from March 16th, 2025.
Okay.
And this newsletter gives us a snapshot of some important market parameters, their observations on market trends, stuff like that.
Okay.
So the mission for us today is to, try to understand the current state of the Indian stock market based on what they're saying in this report, identify the key shifts, from the previous week, which was March 9th, 2025, and really just grasp the overall sentiment of the newsletter. Are they feeling bullish, bearish, kind of neutral?
Right.
So let's jump right into it.
Yeah.
And they lay out some, key, what they call RVCC parameters.
Okay.
And they give us a side-by-side comparison of March 16th versus March 9th, 2025.
Got it.
So let's just run right through some of these numbers, starting with the price to earnings ratio, the PE. They show that it was 19.91 on March 16th, down just slightly from 20.05 the week before. The price to book ratio, the PB, also down slightly 3.33 from 3.36. Market cap to GDP, 110.94%, down from 111.7%.
Okay.
So just at a high level, what do you make of that, PE, PB, market cap to GDP, all down slightly from the previous week?
Yeah. I mean, at first glance, it, seems like it could be a little bit of a pullback in the market.
Yeah.
Maybe a little bit of profit taking after a good run. Or, maybe investors are getting a little more cautious, hesitant, maybe looking ahead to future earnings and not liking what they see.
Yeah. Or maybe, just a slight kind of revaluation, repricing of the market relative to, in the case of market cap to GDP, relative to the overall economy.
That could do.
But then the thing that really jumps out is the relative strength index, the RSI.
Okay.
And that shows a pretty big jump from 43.58 on March 9th up to 65 on March 16th.
Yeah, that's a significant increase.
Yeah. So what do you make of that?
Well, the RSI is all about momentum. So to see that kind of jump, in 1 week from the low 40s into the mid 60s, that definitely tells us there was a big surge in buying pressure, during that week.
Right.
And this could be driven by, anything from positive earnings surprises in certain sectors, maybe, some new policy announcements creating some excitement. We don't really know from just this data point.
Yeah.
But the real question is that momentum going to continue, or was it just a short-term kind of blip, a knee-jerk reaction to something?
Right. Yeah. It's almost like you need a couple more data points to really get a sense of, is this the beginning of a new trend or just a one-off spike?
Exactly, yeah.
Okay, so let's move on to foreign institutional investor activity, or FII activity.
Right.
And they give us the FII net open interest change. And this is always a fascinating one because it gives you insight into how these big institutional players are positioned in the market.
Right.
So for March 16th, it's negative 2,943 CR. And this compares to negative 3,955 CR the week before.
Interesting.
So, the first thing that jumps out is that both of those numbers are negative.
Yeah.
So that means that, overall the FIIs have more bets on the market going down than going up.
Yeah.
However, the fact that the negative number is smaller for March 16th, negative 2,943 versus negative 3,955, suggests that they've actually reduced their net short positions.
Really?
So it's not like they've suddenly turned bullish. They're still leaning bearish overall, but the level of that bearishness seems to have decreased at least a little bit.
It's a subtle shift, yeah.
Yeah, a subtle shift. It's not a complete, 180, but it's a noticeable change.
Yeah, and I think that's really key when you're looking at these reports and these kinds of data points. It's not always about the absolute numbers, but more about the trend and the change from 1 week to the next or 1 month to the next.
Absolutely, yeah. You got to look at the deltas. Okay, so let's talk about the Nifty itself. The index that everyone's watching.
Okay.
It closed at 22,397.0 on March 16th.
Okay.
Which is down from 22,552.50 on March 9th. So, a bit of a downward move there. And the newsletter also mentions some technical indicators that might be relevant here.
Right. So one thing they point out is that the Nifty closed below its 13-day exponential moving average, or 13 EMA, on March 16th.
Okay.
So the Nifty closed at 22,397, and the 13 EMA was at 22,504.
Right.
And that's a change from the week before, where the Nifty closed at 22,552.50, above its 13 EMA, which was 22,549.52.
Right. So for people who aren't as familiar with these technical indicators, what is the significance of that? Are the Nifty kind of dipping below that 13-day EMA?
Yeah, so think of the 13-day EMA as like a short-term trend line.
Okay.
And when you see the price of an asset like the Nifty, cross below that line,
Yeah.
it often suggests that the recent upward trend, or whatever the trend has been, it could be the downward trend too, but it suggests that that trend might be losing steam.
Okay.
And we might see a shift towards, the opposite direction.
Right.
In this case, see this downward move below the 13 EMA, it could suggest that, the recent upward trend in the Nifty Y might be losing steam, and we might see some further downward movement.
Got it. Got it. So it's basically a sign that, the average price over the last 13 days is now above the current price.
Exactly.
And that could be interpreted as a bearish signal.
Yeah, exactly. Yeah, some traders might see that as a signal to sell, or at least to be a little more cautious.
Yeah.
Right. Interesting. And then they also mentioned the India VEX, which is the volatility index.
Yeah.
And that actually saw a slight decrease from 13.47 to 13.28.
Okay.
So how does that fit into the bigger picture here?
Yeah, so a slight dip in the VIX, that usually means that the perceived level of volatility or uncertainty in the market has eased a little.
Okay.
Now, you might think that's a little odd, right? Because we're seeing the Nifty fall below its 13 EMA. There's some downward movement.
Usually you see more volatility when things are moving down quickly.
Right.
But, the decrease in the VIX is pretty small. So it could just be that, there was some selling pressure, but not enough to really spark a big increase in fear or uncertainty.
Right. It wasn't like a panic sell-off.
Exactly. Yeah.
Okay, interesting. So the newsletter also dives into the Buffett indicator and gives us some projected future market returns,
Right.
which is always, something that catches people's attention.
Of course, yeah.
So what is their kind of long-term outlook according to this report?
Yeah, so based on their analysis of what they call the original Buffett indicator, they're projecting an average annual return of 6.2% for the Indian stock market.
Okay.
And they break this down into a few key components. So they're estimating economic growth to be 6.86%.
Okay.
Current dividend yield of the market is around 1.5%.
Mm-hmm.
And then there's a valuation reverse to the mean of negative 2.17%.
So that last part, I think that's always the part that people get a little tripped up on. What does that mean exactly?
Yeah, so the Buffett indicator basically looks at the total market capitalization relative to the country's GDP.
Right.
And if that ratio is very high, it suggests that the market might be overvalued.
Okay.
So this valuation reverse of the mean basically means that, if the market is currently trading at a higher than average valuation, it's likely to, gradually come back down towards its historical average over time.
Right. So they're basically building in a little bit of a correction there.
Exactly. Yeah.
And it's interesting. They also mentioned a modified model that gets to the same 6.2% projected annual return.
Right.
But with a slightly different valuation versus mean of negative 2.18%.
Yeah.
So the economic growth and dividend yield figures stayed the same in both scenarios.
Right.
But the way they're calculating that valuation component is slightly different.
Exactly. Yeah. And, it's important to keep in mind that, as the newsletter itself points out, these are just projections.
Right.
They're based on certain assumptions and historical data.
Yeah.
Relative to other countries, right? So it's not saying that the Indian market is definitely going to return 6.2%.
Right.
It's just saying that relative to other countries, based on these factors, that's what they're projecting.
Yeah. Yeah. So it's definitely not, investment advice or a guarantee of any kind. It's more just a framework for thinking about how attractive the Indian market might be compared to other markets.
Exactly. Yeah. And I think, the best way to use these kinds of projections is to just get a general sense of where things might be headed.
Right.
But not to take them as gospel,
Right. Right. Yeah. There's always a million other factors that could come into play.
Yeah, of course. No one can predict the future. Okay, so let's move on to the market notes and observations section.
This is often where I find the most, interesting, actionable insights.
Yeah, definitely.
So what stood out to you in this section?
Yeah, so a few things jumped out at me. First, they give this specific Nifty Y level to watch.
Okay.
And they say, below 22,000 Nifty Y levels buy more equity in staggered manner, and include multi-asset strategy.
Right.
So that seems like a pretty clear tactical recommendation.
Yeah.
They're basically saying if the Nifty drops below 22,000, they see that as a buying opportunity.
Okay.
But they're also saying, don't go all in at once, buy in a staggered manner.
Right, right. Don't try to time the bottom.
Exactly. And they also emphasize, diversifying your portfolio. So don't just put everything in equities, include other asset classes as well.
Right, right. Which makes sense, especially if you're buying in a potentially volatile market.
Right, exactly.
What else did you see in there?
Yeah, so they also suggest, potential shift in funds if the market continues to go down.
Okay.
They say to, convert flexi-cap to multi-cap funds if we see further declines.
Right.
And I think that's interesting, because flexi-cap funds, they have the flexibility to invest across companies of all sizes, large, mid, and small.
Right.
Whereas multi-cap funds, they typically have a more defined allocation across those different market capitalizations.
Okay.
So I think this suggested shift might be a way to, ensure you have more of a balanced exposure across the market during a downturn.
Right, right. So it's kind of a way to maybe mitigate some of that risk.
Exactly.
And then they also highlight their current sector focus.
Yeah.
And they point to banking, finance, IT, and pharma as areas they're watching.
Right.
So it's always good to, get a sense of where the experts are kind of seeing potential opportunities.
Yeah, for sure.
And then one other thing they mentioned in this section is their historical equity neutral or negative or positive calls.
Okay.
And I think this is really interesting, because they're basically tracking their own sentiment over time.
Right.
And they point out that, the recent negative trend started back in December 20th, 2024.
Okay.
And as of this report, which is March 16th, 2025, that negative trend has not yet reversed.
Got it.
So that kind of gives you some context for their more cautious outlook.
Definitely, yeah.
Okay, moving on to the small and mid-cap stocks.
Okay.
What are their conclusions there?
Yeah, so interestingly, despite the slight pullback in the overall market and some of the valuation metrics we talked about, they say that Nifty Small Cap 100 remains positive, and Nifty Midcap 150 also remains positive.
Okay.
So this suggests that, while the larger companies might be facing some headwinds, the sentiment in the small and midcap segment is still pretty strong.
Yeah, and it's interesting because, a lot of times those small and mid-cap stocks, they can be more volatile,
right?
But they can also offer, potentially higher growth.
Exactly, yeah. So it's a bit of a trade-off.
Right.
But yeah, it seems like, according to this newsletter, the small and mid-cap segments are still holding up pretty well.
Okay, interesting. So let's take a look at that sectoral index performance data from March 16th, 2025.
Right.
What are the key takeaways that we can glean from these numbers?
Yeah, so it looks like, most of the major indices were down on that day.
Okay.
The Nifty 50 was down 0.33%.
Okay.
Nifty Next T50, which is the next 50 largest companies, was down 0.51%. Nifty Midcap 50 was down a bit more, 0.81%.
Okay.
And the Nifty Small Cap 100 was down 0.98%.
All right. So basically confirming that, there was a bit of a downturn across the board.
Yeah, exactly. Yeah.
But interesting that the mid-cap and small-cap segments experienced, slightly larger losses on a percentage basis.
Right.
Compared to the Nifty 50.
Yeah, it's interesting to see those differences.
Yeah.
And when we look at the valuation metrics, we also see some interesting things.
Okay.
So the Nifty Midcap 50 has a much higher PE ratio of 37.55.
Right.
And the Nifty Midcap Select Index is even higher at 40.78.
Wow.
Compared to the Nifty 50's PE of 19.91.
Right.
So this could suggest that, even though the midcap segment was down on that day, it might still be trading at a premium relative to its earnings compared to the large cap space.
Interesting. Okay.
Dividend yields across most of these indices are pretty similar, generally below 1.5%.
Okay.
And then the India VIX, we see that was down 3.01% on that day,
right,
which aligns with the overall trend for the week, just a slight easing of volatility.
Yeah. Yeah. Okay. So to kind of, sum up everything we've discussed today about this weekly newsletter Volatility Coaches of India report, we've seen a slight dip in the Nifty, some minor decreases in overall market valuations. Foreign investors have reduced their negative bets on the market a little bit.
Yeah.
And the Nifty has kind of edged below that short-term moving average, that 13 EMA, which could suggest some weakening momentum.
Right.
The newsletter is presenting a, cautiously optimistic outlook, particularly suggesting that there might be some buying opportunities if the Nifty falls below 22,000.
Yeah.
But interestingly, they're still, pretty bullish on the small and mid-cap segments.
That's right.
So, overall, it's a bit of a mixed bag.
Yeah, I would agree.
Not super clear which direction things are headed.
Yeah, and I think that's often the case with these market reports.
Right.
There's rarely a clear-cut answer. It's always nuanced.
Yeah, and I think that's what makes it interesting, right? You gotta really dig in and think critically about all the different pieces of the puzzle.
Yeah, for sure. And I think, for anyone listening, it's important to think about how all of these indicators and observations fit into your own investment approach and your own understanding of the market.
Yeah.
Do these shifts suggest any potential entry points or adjustments you might want to make to your portfolio?
Absolutely. And finally, here's something to really think about. Given these projected returns that they're laying out, 6.2% annually.
Mm-hmm.
Given those projections and the current market conditions that we've talked about, how might some significant, unexpected global economic event, something that, wasn't even on the radar when this newsletter was written,
Right.
how might that really shake things up and potentially completely derail these projections?
Yeah, that's a great point.
So it's always important to keep in mind that these reports are just a snapshot in time.
Right.
And the global landscape can change very, very quickly.
Yeah, for sure. And, the world is unpredictable.
Exactly.
So we always have to be prepared for the unexpected.
Right. All right. Well, thanks for diving into this with me. It's always a pleasure.
Likewise. Yeah, thanks for having me.
Absolutely. And thanks to everyone for listening.
Yeah, thanks for listening.
We'll catch you on the next deep dive.
See ya.